Hey there, it's John Downs. It is the week of April 28th, and I wanted to jump on, give you a quick market update. And I want to talk a little bit about just markets in general, think stocks and just how are those behaving and how are people feeling. Talk a little bit about housing market, specifically some of the inventory trends that we see, and then talk a little about mortgage rates and some other resources that we're working on that if you're a real estate agent, you might enjoy. If you're someone buying a house, owning a house, you probably find some value in that as well. So first, give you a quick update on the behavior recently. And if you go back just a little bit in time, things were nutty and fearful, right? Stocks were dropping, rates were rising, everyone's kind of worrying about government job layoffs and reduction in spending, and of course, tariffs ratcheting up. And it was just a real weird, uncertain, heavy time. And then we also wound up seeing, if you saw my post from a couple weeks ago, where inventory just went a little parabolic. So then you're like, okay, stocks are crashing. I'm feeling less wealthy. People might be losing their jobs, especially in the DC metro area. The government's cutting back. Interesting. Things aren't looking that good. And I'm going to probably maybe hold off a little. Or if you're a seller, you're like, I better put my house on the market right away. I need to get rid of it before things get worse. So that was like 2 weeks ago. And what's interesting, and I'm going to show you some stock market charts here in a second, that as things rebound, people actually start feeling better. And sometimes the rebound is a product of lots of things, right? It's the stock market going up, it's interest rates going down, it's maybe some of the rhetoric coming in the media about some of the tariff talk being softened and pulling back and improving. Maybe some of it is just you're feeling more wealthy because the stock market rebounded. Maybe it's prices in certain areas rebalancing and sellers being maybe a little more aggressive to get rid of their property. So you pile all that stuff together. It was a busier weekend than I think a lot of people in real estate expected. But still fuzzy. Like I had some houses that were like wildly competitive, not a lot of offers, but really competitive, like escalations, give away your firstborn kind of style. And then I had some others that had multiple offers that were all lower, and I have some stubborn sellers or some possible negotiations. So I continue to say that this is a more micro market than I've probably ever witnessed in like 25 years. I think really good real estate agent on your side is probably key. I think some little areas are going to be super hot, some maybe not, and a good agent might know those differences and kind of tell you what to expect. You can't really paint anything in a broad brush right now. It's like in 2021, like you could paint the whole area, the whole country, and just like buy here, you're going to make a lot of money and value is going to go up. And then I think now we're kind of in, hey, like that section's cool, that maybe not, that over there, yes, but only if updated, right? You're going to find a lot of like if-then statements that will kind of prove market behavior. So now let's just get into markets in general to kind of validate everything that I just said, talk a little bit about rates, and then dive into housing data. All right, first thing I'm going to show you is just the stock market. I never underestimate sort of the connection between how the stock market does and then how people with assets spend their money, right? So if you think of an average homeowner, they probably feel really good about their job and likely good about their assets. Everything is going up and likely getting better in life, so you make a big decision. If all of a sudden those things are fractured, either, hey, I might lose my job, or my assets are dropping and I'm worth less money, then maybe you go into a scarcity mindset. So jobs and asset value is very important. So of course, this is the S&P, let's say over the last, 6 months, roughly 4 or 5 months. And you see we peaked here right in early February, and then we just dropped way down in like 6 weeks, right? It was just awful. It was such a huge drop. It just shock and awe drove everybody bananas. Now this little point here, that bottom, I will tell you that there is a technical support to that. Like that kind of made sense. If I scroll back far enough, you'll see that actually marked about the 2022 top. I don't know if you can see that in that bottom left, but it kind of made sense why we bounced there. And now you can see, if we pull this over, this is sort of a trend line of stocks dropping, and we rebounded, popped over it, and now we're kind of falling back and retesting it a little. So I do think we need to keep an eye on markets right here. I think people are broadly feeling a lot better than they felt like week and a half ago for sure. Let's see if this continues. I wouldn't be surprised if it kind of pushes a little bit lower here before we resume an uptrend. Maybe fill this gap here. What's that, 5,300-ish? Really, it just depends on corporate earnings this week. We have a slew of earnings coming out. And then we also have, obviously, all the tariff talk and tariff news. I think we're expecting some news on that tomorrow. We'll see. So the volatility index, this is called the VIX. Whenever this is above 20, it's usually a sign of stress. And it's been living above 20 for a while. It was living above 30 a few weeks ago. And while that's pulled back, we're starting to see that ramp up just a little bit. I have been also noticing that gold is kind of an inverse trend at the moment. So the more market stress we have, it seems like the more gold pushes higher. So it did have a correction last week at the same time that the market rebounded relatively strongly. So again, just maybe keep an eye on that. Now, mortgage rates luckily are moving in the right direction. So this is sort of my bond trading, not trading, but tracking platform that I like to use. From a consumer level, just know green is good, red is bad. If you ever see me post these charts, but if mortgage rates track the 10-year bond, which they mostly do, not always, but mostly, you could see about a week ago, we were trading, what's that, 4.4, and now we're at 4.2. So rates are certainly moving in the right direction, which is nice to see. Now, if we dive into housing data, so this chart I wound up, this is actually refreshed, but last week I updated this to show housing inventory. And what I pointed out was this sharp rise in the last few weeks. This is the DC metro region. I'm going to show you Baltimore in a second. I'll show you a few of the key counties with both of these MSAs as well. Again, I'm going to do this quickly. You can pause the video and kind of go back. I'll also put all the links of all of these reports in the video description, so you can always go back. And there's a subscribe button. You can actually get these emailed to you every 2 weeks if you feel like it, along with some of our commentary. But what you'll see is this rise in inventory is very similar to that rise that we wound up having in 2022. Do you remember when interest rates jumped all the way up to 8%, like really quickly? And everyone's like, oh my God, real estate values are going to drop and no one's ever going to buy a house ever again. And then all of a sudden it kind of balanced out. Well, the key part there, it balanced out because the stock market started going up. Wages started increasing, right? The economy was still very strong, so it could absorb the higher interest rate. So that's back to that direct tie from equity markets and stock wealth and how that translates over. It's very key psychological thing too. But what I want to point out is it sort of stabilized week over week. Like we went from 5,066 units in DC Metro just up to 5,130. So a very modest increase. And at the bottom of this report, it shows how many new listings and how many absorbed, so how many went under contract. And you'll see that for the most part, absorbed new contracts outpaced new inventory. So that's kind of a sign of strength. So I think that's going to be something I'm going to be paying very close attention to is, was this rise in inventory a product of the time of extreme stress that is now unwinding? And will we actually see consumers kind of run back in now that rates are rebalancing and stocks are stabilizing? So if those two things continue, right, that's the big asterisk there. If we go into Montgomery County, we see sort of the same thing, right? So inventory spiking, but really small difference, 8 extra units of single family homes. And when you look at new and absorbed, it does look like the higher end is maybe a little softer. I mean, again, we're talking about a small sample over the week, right? 13 new listings, 9 under contract. But the rest of them are fairly balanced with absorbed outpacing new. And we see virtually the same thing in Fairfax. So again, big push higher, 8 more extra units on the market, and then new and absorbed, again, a little bit more balanced than we've seen. So all good stuff. Now, the Baltimore market, it has been lagging, I will say. It generally lags the DC market from what I've noticed. And this goes all the way back to financial crisis. I was having a phenomenal year in 2007 when all my friends in DC and Northern Virginia were struggling. They were like, what's happening? I'm like, I don't know. It must be you because I'm killing it here in Maryland. So just know there generally can be a lag in behavior, but we are seeing inventory pick up a little bit. It has been more stable, new and absorbed. Again, a little bit favoring more listings than more contracts. So I think something, again, we have to keep an eye on. And same Baltimore market, so Baltimore County seems a bit more stable. And then Anne Arundel is the one we wound up seeing a little bit of a pickup. So they have about 30 more units, which percentage-wise is actually pretty big. So that's kind of everything on the housing side. I will tell you, there's two things. If you haven't seen my YouTube channel, definitely check it out. I'm actually making an effort to put a lot of time, energy, resources into building out my YouTube channel, mostly for home buyers to understand the process, learn all the different things that we teach on their own at their own time, but also some things for real estate agents to know, specifically the one I'm working on right now that should hopefully be out by the end of the week. And it's all about how the calculators that you see on like Redfin, Zillow, Realtor.com, just how obnoxiously wrong they are. They're so wrong, especially with people putting less than 20% down. So, I think you'll love that video when it comes out. And it's certainly something for you, especially real estate agents, to keep an eye on. The taxes, right, is actually the one big thing that you would think they would have fixed. So anyway, and that's all I have for now. So if you have any questions, drop them in the comments below. Oh, there was one more thing. If you are a mountain biker, just know, I don't know if you can see that. I don't think you can. If you saw my mountain bike video, I took a couple spills this weekend. Just so you know, those little skinny trees, they're not like those skiing slalom poles, when those skiers, they like go down and they're like, boom, boom, and they like hit the pole and they push the little pole down and they keep going to try to get that better angle. I tried to do that a few times this weekend. It did not serve me well. So just know that that's not how small trees work. So until next time, hope to see you soon.